The moment you cross 70 and a half, something quietly shifts inside the tax code. The IRS doesn't send you a letter, your bank doesn't call, your accountant probably won't mention it. But on that exact birthday, 7 separate provisions snap into place, and each one has the power to save you thousands of dollars a year for the rest of your life. Most retirees walk right past them, some never learn they existed, and by the time required minimum distributions hit, the chance to use the most valuable ones is already gone. Think about which ages most people focus on. 59 and a half, when the early withdrawal penalty drops away. 62, when Social Security opens up. 65, when Medicare begins. 73 or 75, when the government finally forces money out of your retirement accounts. Those ages get written about in every retirement article you've ever read. But 70 and a half, it sits there in the shadows, treated like a leftover from an older version of the tax code. And that silence costs ordinary retirees real money year after year without them ever realizing the leak is happening. In the next several minutes, I'm going to walk you through all 7 of these provisions one by one. Some of them protect your Social Security from being dragged into the taxable zone. Some shield you from Medicare surcharges that quietly inflate your premiums. One of them, when used correctly, can outperform almost every other tax strategy available to a retiree. A few you can set up in a single phone call. And there's a specific window of time, only a couple of years wide for most people, when several of these tools are at peak strength. Miss that window and the math turns against you forever. Before I go any further, a quick and honest note. I'm not your attorney, not your CPA, not your financial advisor. What you're about to hear is educational based on publicly available tax rules and current IRS guidance. Your personal situation has details I can't see, so before you act on anything in this video, sit down with a qualified tax professional who can run your specific numbers. Good. Now let's get into it, because the first provision is the one that single-handedly rewrites retirement tax planning for anyone who gives to charity. Number 1, the Qualified Charitable Distribution. Of every tool the IRS makes available to a retiree, this is the heavyweight. And the painful part is how few people use it, not because it's complicated, but because no one ever told them it exists. Starting the day you turn 70 and a half, not a moment before, you're allowed to move money directly out of your traditional IRA and into a qualified charity. The transfer is called a Qualified Charitable Distribution, or QCD for short. For 2026, you can move up to $108,000 this way per person. If you and your spouse are both past 70 and a half, you each get your own limit, which means a married couple can route well over $200,000 to charity in a single year without a dime of it counting as taxable income. Here's why the QCD is so quietly powerful. The money never lands in your checking account. It travels from your IRA custodian straight to the charity. It does not appear as income on your tax return. It does not raise your adjusted gross income. It does not raise your provisional income. It does not push your Social Security into the taxable zone. It does not trigger Medicare surcharges. As far as every tax calculation the IRS performs is concerned, the money simply isn't there. And once you're old enough that required minimum distributions begin, that same QCD also counts towards satisfying your RMD for the year. Picture 2 retirees, side by side, both giving the same $15,000 to the same church. The first one takes a $15,000 withdrawal from his IRA, pays income tax on it, watches a chunk of his Social Security become taxable because his provisional income just jumped, and then writes the church a check from his bank account. By the time the smoke clears, that $15,000 gift has cost him somewhere between $2,300 and $2,800 in extra federal tax. The second retiree picks up the phone, tells his IRA custodian to send the $15,000 directly to the church, and that's it. Tax on the transfer? 0. Effect on Social Security taxation? 0. Effect on Medicare premiums? 0. Same gift, same church, same dollar amount. One pays the IRS thousands, the other pays nothing. The only difference is the route the money traveled. Let me make this real with a quick example. A married couple, both 72. They quietly give around $10,000 a year, 8 to their church and 2 to the local food bank. They've been writing personal checks for 20 years. Their Social Security is around $38,000. Their IRA withdrawals are $25,000, and they earn another $3,000 in interest. And with that mix, their provisional income comfortably crosses the threshold where 85% of their Social Security becomes taxable. Now they make one small change. They cut their IRA withdrawal to $15,000 and send $10,000 directly to the church and the food bank. As a QCD, their adjusted gross income drops by $10,000. Their provisional income slides down with it. The amount of Social Security being taxed collapses. Their federal tax bill falls by roughly $2,000. Over 10 years, that's $20,000 they keep on charitable giving they were going to do anyway. Now, 3 traps to avoid, because I've seen all 3 undo people's good intentions. First, do not have the custodian send the money to you first. The instant that check hits your account, it's a regular taxable distribution, even if you turn around and donate it that same afternoon. The money has to travel directly from custodian to charity. Second, donor-advised funds don't qualify, and the IRS specifically excluded them. The recipient has to be an operating charity. Third, and this one stings, you must actually be 70 and a half on the day the distribution leaves the account. Not the year you turn 70 and a half, the exact day. A QCD made one day early disqualifies the whole transfer. Drop a comment and tell me, honestly, had you ever heard of a QCD before today? Yes or no? I'm curious how deep the silence really goes on this one, because it might be the most expensive blind spot in modern retirement planning. And believe me, what comes next builds on it in a way most retirees never see coming. Number 2, the one-time QCD into a charitable remainder trust or charitable gift annuity. This provision is newer, and it's one of those quiet additions buried inside recent legislation that almost nobody talks about. You're allowed, exactly once in your lifetime, to make a QCD of up to roughly $54,000 from your IRA into a charitable remainder trust or a charitable gift annuity. One shot, one lifetime. But the impact can be enormous. Here's the magic of it. A charitable gift annuity, or a properly structured charitable remainder trust, pays you income for the rest of your life, then sends whatever's left to the charity when you pass away. Normally, funding one of these arrangements with IRA money means pulling that money out, getting hit with income tax on the full withdrawal, and then contributing whatever's left over. With this special provision, the IRA dollars travel directly into the trust or annuity without ever appearing on your tax return as income. On a $54,000 transfer at a 22% rate, you're looking at roughly $12,000 saved on the transfer alone, plus everything you avoid in Social Security taxation and Medicare surcharges. For a retiree who already plans to leave money to a cause they care about, this single transaction can swing the math by $15,000 or more, and it creates guaranteed income for life on top of it. But here's where it gets interesting, because the next provision is one that almost nobody is even aware exists, and it's the one with the tightest expiration date of them all. Number 3, the pre-RMD reduction window. This is the provision retirees miss the most, and the reason is simple. Nobody explains the calendar. QCDs become available at 70 and a half, but required minimum distributions, depending on the year you were born, don't begin until 73 or 75. So between those two ages, you're sitting inside a window that lasts somewhere between 2.5 and 4.5 years. During that window, you can use QCDs to quietly shrink the size of your IRA before the IRS ever forces a single dollar out. Why does the size of the IRA matter so much? Because your future RMDs are calculated based on the balance in the account on December 31st of the previous year. The bigger that balance, the bigger every forced withdrawal will be for the rest of your life. Bigger forced withdrawals push more of your Social Security into the taxable zone, raise your Medicare premiums, and bump you into higher brackets. Reduce that balance by even $60,000 or $80,000 during the pre-RMD window, and every single RMD that follows is smaller every single year, permanently. Picture a woman who turns 70 and a half this year with $500,000 in her traditional IRA. Her first RMD won't hit until 75. She has 4.5 years of breathing room. If she routes $15,000 a year in charitable giving through QCDs instead of writing checks, by the time RMDs begin, her balance is roughly $60,000 lower than it would have been. Her first RMD is about $2,400 smaller. That $2,400 reduction repeats every year for the rest of her life. With the ripple effect on Social Security taxation, she's saving somewhere between $700 and $900 a year for 20 years or more. $15,000, maybe $18,000, just from using a window most retirees never knew was open. And once RMDs begin, that window snaps shut. You can still do QCDs, but the rules change in a way that takes away the early advantage. The clock is ticking, and most people don't even know they're holding a stopwatch. Number 4, the last clean Roth conversion window. If you're 70 and a half right now, listen carefully, because this might be the single most valuable strategic moment left on your retirement timeline. You have somewhere between 2.5 and 4.5 years before RMDs begin, and every one of those years is precious for Roth conversions. After RMDs start, conversions don't disappear, but they get crushed. Why? Because the RMD has to come out first. That forced withdrawal fills your lower tax brackets. Anything you try to convert stacks on top of it, often spilling into the 22% bracket or higher, plus dragging more of your Social Security into the taxable zone at the same time. Right now at 70 and a half, if you've kept your other income under control, you may still have meaningful room inside the 12% bracket. 30,000, 40,000, sometimes 50,000 of conversion space at a low rate. Every dollar you move into a Roth today at 12% is a dollar that doesn't come out later at 22, 24, or even an effective rate north of 30% once you factor in the Social Security cascade. On a $50,000 conversion, that's $5,000 to $9,000 in lifetime tax savings per year of conversion you actually pull off. Run the comparison and the urgency becomes obvious. At 70 and a half, a single filer with modest Social Security and a little interest income often has more than $30,000 of room in the 12% bracket before she crosses into 22. Fast forward to 75. Same retiree, same Social Security, but now an $18,000 RMD has slid in underneath everything. Her 12% room has been cut roughly in half. By 80, it's smaller still. By 85, the RMD alone may swallow most of the lower bracket, and the cheap conversion window is essentially closed for good. And there's one more layer to plan around. Medicare. Every dollar you convert counts toward the modified adjusted gross income the government uses to decide your Medicare premiums 2 years later. A conversion you do at 70 and a half doesn't show up on your Medicare bill until 72. So you're not just planning around the tax bracket, you're planning around a surcharge that arrives on a delay. The conversion almost always still makes sense, but you need to size it with both eyes open. And if you think that's strategic, wait until you hear about a tiny reporting change the IRS just made that has quietly returned money to retirees who didn't even know they'd lost it. Number 5, the new code Y on your 1099-R. This isn't a strategy. It's a fix, and it solves a problem that's been silently costing retirees money for more than a decade. Starting with the 2025 tax year, the IRS introduced a new code, code Y, that appears in box 7 of your 1099-R. That code tells your tax software, your preparer, and the IRS itself that a particular distribution was a qualified charitable distribution. Before code Y existed, QCDs were reported on the 1099-R looking like any other distribution. Your tax software saw the withdrawal and treated it as taxable income unless someone manually corrected it. And if nobody noticed, you paid tax on money the IRS was never supposed to touch. This happened constantly. A retiree would do everything right, route the donation directly to the charity, satisfy all the rules, and then quietly overpay their federal tax in April because the QCD got swept in with everything else. Some caught it, many didn't. Code Y closes that gap. The distribution is now flagged from the moment it leaves the custodian, and the tax software knows to exclude it automatically. So here is your action item. Pull out any 1099-R you received for 2025. Look at box 7. If you see code Y and that amount got reported as taxable on your return, you overpaid the IRS. You have up to 3 years to file an amended return and pull that money back. For some retirees, that's hundreds of dollars sitting on the table. For others, it's a few thousand. Either way, it's yours. Number 6, the maximum Social Security benefit and the new rules of provisional income. If you waited until 70 to claim Social Security, your benefit is now locked in at its highest possible level. Every year you delayed past your full retirement age added roughly 8%. At 70, you're collecting about 132% of your full retirement age benefit, with cost of living adjustments stacked on top of it for the rest of your life. By the time you reach 70 and a half, you've been receiving that maximum benefit for 6 months, and now the question changes completely. The question is no longer, when do I claim? The question becomes, how do I protect this from being taxed away? This is where provisional income management becomes the most important calculation in your retirement. Provisional income is your adjusted gross income, plus any tax-exempt interest, plus half of your Social Security. For a single filer, once that number crosses $34,000, up to 85% of your Social Security becomes taxable. For a married couple, the line is $44,000. Now consider what that means at 70 and a half. If your maximum benefit is around $40,000 a year, $20,000 of that is already inside the provisional income calculation before you've touched another account. You have just $14,000 of breathing room as a single filer before you slam into the 85% zone. So every dollar of additional income suddenly matters in a way it never did before. A $10,000 withdrawal from your traditional IRA might be the dollar that pushes you across the line and yanks $20,000 of Social Security into the taxable column. But a $10,000 QCD, the exact same dollar amount, the exact same charitable intent, keeps your provisional income safely below the threshold. Same money, same lifestyle. One choice taxes your Social Security. The other keeps it untouched. At a 12% rate, that single decision can save you well over $2,000 every single year. And this is the deeper reason 70 and a half is such an important age. The QCD becomes available at the exact moment provisional income management becomes critical. The two tools are designed to work together, and the IRS will never connect those dots for you. But the 7th provision, it's where everything you've heard so far stacks into something that can take your federal tax bill down to almost nothing. Number 7, the senior bonus deduction stacked with QCDs and Roth income. Recent legislation created a brand new deduction for taxpayers 65 and older. $6,000 for an individual, $12,000 for a couple where both spouses qualify. It begins to phase out at higher incomes, but for most retirees living on a typical Social Security and IRA mix, it applies in full. At 70.5, you're well past the age threshold. The deduction is yours, but the deduction by itself isn't where the real power lives. The real power shows up when you stack it on top of QCDs and Roth withdrawals. Let me show you what stacking looks like in real life. Imagine you need $50,000 a year to live. Social Security gives you $30,000. You need another $20,000 from your retirement accounts. Instead of yanking the whole $20,000 out of a traditional IRA, you pull $10,000 from a Roth, which is completely tax-free and completely invisible to the IRS. Then you route another $10,000 from your traditional IRA directly to your church as a QCD, which is also invisible to the IRS. Your adjusted gross income is essentially just your Social Security. Your provisional income sits well below the threshold. None of your Social Security is taxable. The senior bonus deduction then erases what little taxable income is left. You lived on $50,000, you supported your church, and your federal tax bill rounds to zero, completely legally. Now look at the neighbor who pulls the entire $20,000 out of his traditional IRA the old-fashioned way. His provisional income jumps. He crosses the threshold. 85% of his Social Security becomes taxable. His federal tax bill is $2,000 to $3,000. Same income, same lifestyle, same charitable giving. One pays nothing, the other pays thousands. The difference is knowing how to combine three provisions that all become available by the time you hit 70.5. The IRS will never explain this combination. Your tax software will not suggest it. And most preparers won't model it unless you specifically ask them to. And if you happen to live in one of the handful of states that still tax Social Security, this stacking strategy keeps paying you at the state level too. Every dollar of Social Security you keep out of the federal taxable zone is a dollar. Your state cannot touch either. But here's the catch, and it matters. The senior bonus deduction is temporary. It runs for a limited number of years, and unless Congress extends it, it disappears after that window closes. So if you are sitting at 70.5 today, you have a small handful of tax years to take full advantage of it. At $12,000 a year for a couple, that's a meaningful pile of deductions left on the table if you ignore it. Use every year of it while it's still there. Now let's bring all 7 of these together so you can see the full picture. At 70.5, the IRS quietly opens the door to the Qualified Charitable Distribution, letting you move 6 figures out of your IRA each year, tax-free when it goes to charity. It opens the one-time, larger QCD into a charitable remainder trust or gift annuity, a once-in-a-lifetime move that can save you tens of thousands. It opens the pre-RMD reduction window, where every dollar you redirect today shrinks every forced withdrawal for the rest of your life. It opens the last clean Roth conversion window before required distributions compress your bracket space. It introduces Code Y on your 1099-R, so for the first time, your QCDs are reported accurately and you stop overpaying by accident. It puts your maximum Social Security benefit directly in the path of provisional income management, where one good decision can keep tens of thousands of dollars off the IRS's radar. And it sets up the stacking strategy that combines the senior bonus deduction, Roth withdrawals, and QCDs into a near zero federal tax bill. 7 separate provisions, all sitting there, all waiting, and almost none of them ever explained. So here's what I want you to do this week. 3 things, simple and specific. First, if you give to any charity in any amount and you are past 70.5, call your IRA custodian and set up a QCD before your next gift. The form takes 15 minutes. The savings repeat for the rest of your life. Second, sit down and calculate your provisional income. Add your adjusted gross income, your tax-exempt interest, and half your Social Security. Look at where you land compared to the thresholds. If you're over the line, ask yourself how much of that extra income could be replaced with Roth withdrawals or QCDs. That gap is the money you can take back from the IRS. Third, dig out your most recent 1099-R. Look at Box 7 and check for Code Y. If a QCD got swept into your taxable income by mistake, you have a small window to amend your return and recover what's yours. Before you go, tell me one thing in the comments. Out of all 7 provisions, just type the number 1 through 7 that surprised you the most. That single number tells me what to dig into next, and the most common answer becomes the next deep dive. If anything in this video gave you a moment of, I had no idea, go ahead and hit the like button so YouTube knows to put it in front of other retirees who deserve to hear it. And subscribe if you'd like more breakdowns like this every week. There's a lot more the IRS isn't going to tell you, and I'll see you in the next one.